from what you're saying, then that should indicate that it's an overweight on banks. And maybe the best way to play the capex cycle turnaround, which you were just talking about.
So I think over the next 3 to 6 months, you'll get good entry points for financials. Look, if the view is that we are not going to go through this period of hyperinflation, but at the same time, it's not an exceedingly low inflation, rates are going to normalize a bit. These banks get pricing power with a decent GDP, nominal GDP growth. You'll see credit offtake picking up. So right now, what we're seeing is signs of working capital picking up. But then, if we believe in the investment cycle, your demand for new projects should also pick up. So that's good from a financials perspective. Valuations are reasonable. If you look at other parts of the market, consumer discretionary, these companies were at a record gross margins, and they're seeing some bit of a contraction of that gross margins. If you look at these names, staples or discretionary over the last 10 years, valuations are double of what they were in 2013-14. So with the global rates normalizing, some bit of a valuation contraction is there. So from that perspective, financials seem the best proxy to play this economic recovery.
What about the semiconductor chip shortage? Is the issue behind us? Is it close to resolution, or are things status quo?
So as I've been saying that, the chip shortage, the situation seems to be getting better over the last few months. If you look at our September production was just 40% of our plan. October was 60%, November was 83, 84%, December was 90%, January was 92, 93%. February also was very good. So I think overall there seems to have been an improvement in the situation. But I can, of course, tell you that, and we have confirmed that it will not be 100% even by the end of this year. So 100% exactly when it will become normal is a little difficult at this time to predict because of the complex supply chain that is involved. And it is not just Maruti Suzuki in India, but also all OEMs across the globe which have been affected in this process.
This disruption that is in all likelihood going to happen because of the geopolitical tension, what is it going to mean for India? What is it going to mean for cooking oil? What is it going to mean for FMCG companies?
With this crisis, of course, India, as you said, India imports almost around 70% of its sunflower oil from Ukraine. And presently, the situation doesn't warrant any supplies. The country is having around 45 days of stock, 60 days of stocks. That is the normal stock that we all carry. We must all understand that India consumes 23 million metric ton of oil, and sunflower oil is only 3 million ton, which is around 12% to 13%. Now, normally in such situation, we have seen there will be demand shift, almost 50% demand shift towards palm oil and soyabean oil. So the core sunflower consumers would remain at roughly around 5% of the total edible oil consumption in India. I think we have enough oil to manage that supply chain at least till the time the normalcy returns, which we feel everything will happen soon, and in 30 to 60 days, these supplies will reach India. So we aren't panicking so much. Internationally, obviously, because one oil goes up, the other oil has an impact. So palm oil and soyabean, we have seen inflationary trend abroad. In India, prices are fairly stable.